Maverick traders. Welcome out to your trading earnings class. We have some Maverick traders here attending live. Feel free to type in any questions that you have as we go throughout this material. Now, as we dive into earnings, we want to kind of take a step back a little bit and really dissect what's happening and why earnings announcements are so important. And in order to do that, let's pull up a whiteboard here and discuss this together. So when you think about earnings, why are so many people that trade in the markets well aware of when earnings occur and why it's so important? Well, it's an update to the company, right? It's basically an update to the top and the bottom line. So there's two major uh, pieces to a business. Revenue, that's the top line. How much money do you bring in? And total revenues give you an understanding of whether business is increasing, decreasing, staying the same. We can compare revenue to the prior quarter, to the same quarter last year. We can make projections and all of these sorts of things, but this is how much money the business is bringing in. So let's imagine, let's just take a business, for example. Let's say Pizza Hut or whatever. Every time somebody orders a pizza and then pays for their pizza, that is revenue. That is top line money coming into the company. But that's not earnings. Earnings is the bottom line, right? And it's how much, there's different names for all these things. A lot of times revenues will be called sales. A lot of times earnings will be called net income. How much did you actually make? Because revenue is just the top line. It's the total amount of funds that company brought in for that 3-month period of time. But earnings are what you actually keep. So it's kind of like saying revenue is sort of like to a household how much you make at your job. But that doesn't mean you keep that, right? You have to pay for your expenses and the kids to do this and for this utility and so on. So earnings is kind of the free cash flow. It's what you're left with once you've paid all your expenses. And for a company, that means once they've paid for all the supplies, paid all the employees, paid all these expenses, you're left with the total amount of income. Now, that amount of income can be, they can do a couple of things. There's two general ideas. They'll have what's called retained earnings. So they'll keep the money that they've made and retain some of that as a little bit of a safety net, kind of like a defense fund where people have an emergency fund. Companies do the same thing. Or they'll keep retained earnings and reinvest it. They'll say, hey, this is a good business opportunity. We should open up a new store over here. All of those things cost money, and they can use the money they're making to invest in future business opportunities. Or they can pay that money back and they can divide it up, which is where the name dividend comes from, right? Divide all the profit up and send some of that out to the shareholders. Now, the dividend, usually they won't pay out 100%. The ratio would be less than 100. They don't earn, and send all that money out. It might be, if somebody pays out 20% of their earnings in dividends, then we would call that well covered. They have plenty of money, plenty of profit to cover the dividend. They're at no risk of cutting it. Sometimes the dividend becomes 100% or more, which means basically in order to keep paying that dividend, they either need to A, improve the business greatly, which is not usually a quick turnaround, or B, they need to borrow some money to keep paying the dividend. And borrowing money and paying interest to pay a dividend doesn't make sense long term. They might get away with that for a quarter or two or whatever, but you can't just keep borrowing money and paying a dividend. So once you start, your payout ratio becomes close to 100% or more, that company is very likely to start slashing the dividend unless something improves greatly. So as an example of this, let's take the oil markets and really think about, the oil markets are a great example of revenues and earnings and so on, because in 2020, when COVID hit, people stopped traveling and oil prices plummeted and eventually went negative. Well, what did that do to revenues and earnings? First, in some cases, Exxon and Chevron and these companies weren't making enough profit to cover their dividend. they had to borrow money in the short term to kind of cover it. Or some of the energy companies slashed and cut their dividend and said, hey, we got to save money. We just can't survive. And we don't know when it's going to turn around. Fast forward just a short 2 years later, and oil prices have boomed. And so now these oil companies are bringing in more revenue and more earnings, which is EPS, earnings per share, and they have ample amount of profitability to pay out and cover the dividend. So it went from, over 100% payouts when they were really struggling to now being a smaller percentage. In some cases, it might be 30% or something, meaning that they can retain 70% of the earnings, pay out 30% of it, and still easily cover that dividend. Sometimes when you have a low payout ratio, it's a very good sign because the company is making so much money, they really don't know what to do with all of it. And they'll raise the dividend and so on. So this is kind of the business side of it. And the reason this is so important is that's what earnings are all about. Earnings are where you get an update to these numbers and you get to see whether the company's doing better or worse. And it's pretty simple process to kind of see whether a company is doing better or worse. So watch, if we go to, let's just pull up Google Finance as a free website. And if we go to Google Finance, we could pick any of these stocks. I mean, we could put in any stock we want. Let's just go to blockchain, okay? Square. If I look at Square and I say, okay, what's happening at the business? First, we can see the quarterly and we can see the revenue and the net income. And what do you see out of Square? Well, they made less in revenue in June 2021 than they did the quarter before. And then the next quarter, it went down further. The next quarter, it went up a little bit, and then the next quarter back down. You can see that the revenue, if we just compare this most recent quarter to the last one, it tells us right here, it dropped 21%. So something inside of Square is not going quite right. The customers are not spending more. This company's not bringing in as much in sales, right? So revenues are declining. If we look at profitability, that's the yellow bar. Well, we had a little uptick in profitability. So we had a bad revenue, but a good earnings number. So those don't match up. That's kind of I don't know. And then the earnings went back to zero. So that was bad and bad. And then the revenue ticked back up, but the earnings went negative. So that's bad. And then last quarter, the revenue and the earnings both took a hit, and that's bad. What do you think that stock price is reflecting? If you just think about what's the trajectory of that chart when things are getting worse, worse, worse. I mean, there's one uptick here in earnings, but that's a one-off number, as we would call it. That's not the trend. That's just, hey, maybe they, why could earnings pick up that one quarter? Well, maybe they sold something. Maybe they sold an asset, and that's a one-time boost to earnings, but that's all it is. And so the point here being, when you really think about the financial markets, when things are getting worse and worse, what do you think the stock chart is going to look like? Well, interestingly enough, if we go to a stock chart, let's go to Square's stock chart here, and let's go back a year and a half or whatever we were looking at there, and you see the stock price, it pretty much reflects the nature of that business, that things are not as strong as they were, that something inside of the business, is struggling and they're taking a hit and so on. When you hear news every day in the market, there could be positive news or negative news, and it's usually in regard to earnings or revenues. This is what you'll hear constantly. Go turn on Bloomberg and they'll talk about, Target today. What did Target do? Well, they said, we're pre-announcing, so we're coming out with an announcement before earnings because we can already see that these are going to take a hit. And we can already see that the business is, turning a little worse. Now, it's bad might be the wrong term, but you get my point in that, hey, these are both going to take a hit. Why? Because we got all this inventory of stuff that we can't sell. And so we have to mark down the prices, which mean our profit margins are lower. They're projecting 2% profit margins. Well, what do you think Target stock price is doing, as a result of this? The last couple of quarters, they've come out and said, and they're not alone, by the way, Walmart, same thing. They shocked the market with a huge surprising miss, and the stock absolutely got blasted. This is the fundamental numbers. This is the revenue, the earnings, and people going, wow, that was not expected. And so, if you understand how Wall Street works, a lot of Wall Street creates models. Whoops, let me rewrite that. Creates a model. And in this model, there's discounted cash flow models. There's all these models, but basically, they put in numbers and it will spit out what hypothetically they think that stock price should be worth. What do they have to do with all of their models? They have to put in lower numbers. The company just told them, hey, revenue is going to take a hit, earnings are going to take a hit, we're on a bad pace. So every one of these models, they got to go back and say, well, we were pricing in that they were going to have 5% margins, and now it's down to 2. And we were expecting them to have such and such a revenue, and now it's down to this. And we were expecting this much in earnings, and now it's down to this. And hey, this is assuming that things go as planned, and it might get even worse of an environment, because not only does Target have these problems, but Walmart. So to assume that they can just get out of this, and mark down prices and have customer demand, it might be even worse than what they're expecting. So all of these models, every one of them has to put in lower input prices. Has to say, well, if our revenues go down, if our earnings go down, essentially, they have to assume the stock is worth less than what they had it worth previously, right? So this is how Wall Street works, is when they model it out and what the stock is worth. Now, they might still say, you know what, based on our models, we still think it's a good value here because it's down at 153, but we think it should be worth 180. But look, just a quarter or so ago, they probably thought it was worth 250. And they have to mark it down to 180 because it's a very different scenario. You change all these numbers, and the assumed value of the company is going to be lower, right? Now, the flip side of that is, well, what if a company comes out with better than expected earnings? There was another company today, GitLab, GTLB, and they reported earnings, and they beat on revenue, and they beat on earnings. And so the models that are out there on Wall Street said, hey, these numbers are better. That might mark up our expected value. We had it priced at worth 60. Based on how well the business is doing, we might think it's worth 65, 70, 75. And so even though the stock's kind of up, they might be buying. So I think it's important to understand the reasoning. Wall Street is not just kind of guessing at it as much as they're trying to put in numbers and data and say, okay, well, based on our models and what we think this is worth, here's kind of how it works. And they won't price in, all of these things ahead of time, because sometimes things are known and sometimes things are unknown. Now, if there's what they call earnings whispers, basically, if the company has given pretty good guidance and said, hey, we're going to beat, we're going to hit these numbers and so on, and it's not a surprise, then it can be known, and usually the stock has less of a reaction. When the company itself, they might say, hey, it was a surprising beat, but maybe it wasn't a big surprise. Maybe Wall Street kind of knew going in, hey, they're going to beat on earnings. It's kind of like Apple for many years. Apple would always set their earnings and revenue projections a little lower. And then every quarter it would be, hey, Apple beat on earnings. And they would have to raise their price targets because Apple was just making so much money. And then they'd beat the next time. And the market kind of knew, okay, well, Apple's, putting in low numbers that they can easily jump over. They put in a low hurdle so that they can beat on those numbers. Now, an unknown, a real shocker, that the market was not pricing in, as you would imagine, those get the big reactions, because some of the expectations understand that companies, employ analysts that go out and follow these companies and do channel checks and kind of have a good understanding of the business and how the business is doing. But there will still be some shocks and some surprises. Target and Walmart being a great example, where it kind of blindsided the market and blindsided those investors because it wasn't something that the market was expecting and pricing in. And when that happens, again, you'll see bigger reactions in the stock. So that speaks to energy, kind of the energy of the move. Now, there's three basic concepts that tend to happen around earnings. Number one, when a company reports earnings, the stock moves more than on a normal day. This is very, very common. Now, does it have to? Is it possible that some stock will move less than on an average day? It's possible, but unlikely. Usually, when earnings come out, the stock is going to move more than normal. So there's something called ATR, average true range, which just represents how much does the stock move on average per day. Let's say it has an ATR of 5 and it's going into earnings. Are you going to expect that stock to move $5 between today and tomorrow if it's reporting earnings after the bell today? You're going to say no. This is its average. It's going to move more than that. It's going to move, $7.50, $8, $10, $12. We can actually measure that. We can measure what the market expects, but it will be more in the vast majority of circumstances. Number two, so not only does the stock move more than expected, options price in more movement. Options are pricing in, let's just say priced in, that fact. The fact that the stock will move more than normal. The options market's not dumb. They price in everything that is known. If there's a Fed meeting before that expiration, it's priced into the options. If the company reports earnings before that expiration, it's priced into the options. If, not only do they price in market dynamics, they price in individual stock dynamics. If that company has an investor day, an analyst day, something that could create a little bit of volatility, it gets priced into the options. So that's important to understand, in that it's not a shock to the options market that the stock's going to move on its earnings. They price that in. Think of it like this. If a hurricane, it has a certain probability. Let's just say that there's a 10% chance of a hurricane hitting Florida panhandle this year or something. And then a hurricane's coming in and they say, okay, there's a 30% chance that this one's going to hit. What do you think insurance is going to cost? Do you think that the insurance company is dumb and they're going to say, well, there's always a 10% chance, so we'll sell flood insurance at 10%? No, they're going to say, hey, the hurricane's here and probability of a volatile situation has increased. Now there's a 30% chance that the Florida panhandle or whatever is going to get hit. So it's going to be priced into the insurance if you want to buy that flood insurance. Same dynamic in the options market. It's going to price that in. Last, number three, the usual reaction, more times than not, is a volatility crush. Now, statistically, that should happen about 68% of the time, one standard deviation. About 2/3 of the time, the volatility gets crushed. About 1/3 of the time, the volatility spikes. The stock moves more than expected and so forth. And that's kind of the statistics of it. Hey, most of the time it's going to be in this range. On occasion, about 32% of the time, you might have a big reaction. And that's how these are kind of priced in. So who has the advantage when you're trading earnings? Well, it's a trade-off. You could say somebody that sells options has a higher probability of success, but more risk. Okay, they might get it right 68% of the time, but on the 32% of the time it goes against them, they could have some real bad, hellacious losses. The buyer of options, statistically, is at a disadvantage from a probability standpoint. The buyer of options has a 32% chance of success. The other side of this, right? The seller of the option gets this advantage. The buyer of the option gets the other, but they have more reward potential. If the stock makes a huge move, this can be a big boom to the option buyer. The option buyer can really profit from that. And if you have paid attention during this most recent earnings cycle, who's been rewarded overall in this market? Option buyers or option sellers over the past quarter, going through earnings and so on? Well, no question. These guys right here, some of the 32 percenters, the lower probability, those are happening, right? We looked at Target, we looked at Walmart. Well, they're not alone. If you go down the list, I mean, stock after stock, you could say, let's take a look. Let's just say Amazon. Amazon, huge gap down on earnings. Netflix, huge gap down and sell off on earnings. Facebook or whatever, huge gap down on earnings. DocuSign, okay, massive. That's like a 50% drop. The stock was, I mean, as you kind of look at this, and by the way, here's a huge one as well, where it went from 95 to 75. That seems pretty violent, but how about this? Finish the prior day in the 230s. The next day, you're at like the 130s, almost 50% decline. So some of these drops in 2022 and kind of this last, let's call it the last couple of quarters, have been pretty hellacious. And the list goes on and on. So option buyers have certainly been the beneficiaries of late of a lot of unexpected, really bad earnings results and overpriced stocks and all these sorts of things that have just been blowing up. And it's been a minefield where this stock gaps down huge and then that one does and then this one does. And that's kind of been the bear market environment that we've been in. It's large cap, it's small cap, it's all over the place. It's, from a variety of those sectors. Now, if you look at energy, certainly it's not anything like that. When energy companies are reporting, they're gapping up. They're rallying. They're going higher. Why? Well, it comes back to the numbers. Square, okay, huge decline. DocuSign, why did it go down? Well, just go look at the numbers. Look at these earnings and whatnot. The revenues have actually been fine, but look at the earnings and the drops. And by the way, sometimes even an increase in revenue might be bad if they were expecting a larger increase. Or you look at something like, Netflix or whatever, and you'll see the declines where there are, some things that have been slowing. And most of the time when traders look at earnings, they always say guidance is what matters most. Usually it's more about the guidance than it is the actual number here, because the guidance tells us where's the next bar going to go. If they guide and they say it's a bad environment, which is kind of what Netflix and some of these companies just did, then these are going to take a big hit. So you don't even have to wait for the bars to appear. You don't have to wait for 3 months and say, oh, now we've got the bad news. Now it should sell off. No. It's always guidance. The market's forward looking, so this matters much more than even the actual number. The actual number usually, again, will be pretty close to expected, right? Usually it'll come in not a huge surprise. In fact, if they were going to have a huge surprise, they need to do what companies are doing right now, which is pre-announce. If you're going to have a massive miss and you've been guiding a different way, you actually have to come out mid-quarter as you start to realize it and say, hey, by the way, this is going to be much worse. You could come out, if it's going to be much better, you can come out mid-quarter and revise your earnings estimates. But a lot of earnings and those things type of revisions are happening right now. Target just did one today and the stock gap down. So guidance, the future, what these bars are going to look like in the future, that's the key. That's the key element to why these stocks are moving. So knowing what we do, that the stock's going to move more than normal, let's go to a NASDAQ earnings calendar. I always like this. If you go to the NASDAQ earnings calendar, it's kind of a really cool way they have it set up where you can click on any date and see which companies are reporting. And usually they'll put kind of bigger name companies along the top. So if we look at, there's DocuSign, which we talked about, or we go to Friday, there's not too much. We're kind of at the tail end of earnings season. Next week, you'll start to get some more companies. Let's go. Whoops, I didn't go out far enough. I need to go this way. There we go. You'll start to get retail companies reporting late in the cycle, and we've kind of passed some of that. But there's Lennar, a big home builder, and you can just click through Adobe, big technology company, and you can see. So rather than, of course, we could look up any individual company, put in its symbol, and see when it's going to report earnings. Well, we could also look at the calendar to see what's reporting and when and so forth. So if we come back to this week, on Thursday, DocuSign's going to report. Now, here is the consensus analyst estimate. They're expected to lose 8 cents, which is, by the way, worse than last year at the same time. Last year, they reported a loss of 3 cents per share. This year, same time, they're expecting to report an 8-cent loss. Why has that stock been going down? Because those numbers are going down, right? Because the guidance is, hey, our business is struggling. It's going to report less in revenue, less in earnings. The models have to price that in, and the company's been reflecting that. It's going to be more, if they report an 8-cent miss or even a 7-cent miss and they beat the expectations, they do a little bit better than expected, that's not going to matter as much as just the forecast. What do they forecast for the future? If it's still a really rough environment and they forecast lower numbers, you can easily see the stock trade lower. If they shock and surprise and for some reason come out with much higher expectations, you can see the stock trade higher. Sometimes you want to look at those things and kind of say, well, what's my feel? Where do I think this business is at? How is it trending? And it's just not that complicated. I mean, really, most of these companies just have to guide lower. I mean, DocuSign, it's probably not booming. Business is not, just it's doing wonderfully well. The housing market where a lot of these documents are utilized and people it's going to slow and has already started to slow in terms of sales. And those things can hurt. Whereas if you look at energy is just the obvious one. Well, look at what causes the company to report better or worse. Well, for energy companies, heck, oil prices keep going higher, natural gas prices keep going higher. These energy companies just keep printing more and more money. So at some point, you get kind of exhausted. And I'm not saying to chase energy up here because it's a different equation, but it certainly has been more obvious to trade energy to the upside for most of this run, given the fundamental backdrop, given the release of raised revenues, raised earnings, and such. It's a little harder if you're going to try to be mega bullish on some of these other companies because the fact of the matter is the numbers are just going to be rough here for a while. Now, let's talk about what gets priced in. So, if I come over to DocuSign, which reports on Thursday, it's trading at $86. Check this out. We can forecast exactly how much the options are pricing in terms of movement. So if we take the at the money straddle, stock's at 86, go find the strike price that is closest to that price. And let me change my color. That black doesn't show up very well. See the 86 strike? That's what we call at the money. Take the value of the at the money call and put, and add them together. So we have about 840 plus 810. Okay. If I kind of split the bid-ask spread here and here, I'll make it simpler math. 840 plus 810. What is that at the money straddle telling me? It's telling me that a buyer of volatility, somebody that wants to bet on this stock having a huge reaction, has to pay $16.50 for the at the money straddle. What are they going to get for that? They're going to lose 68% of the time. They're going to win 32% of the time, but the win could be a huge windfall if the stock just cascades one way or the other. If the stock goes much more than 1650, much more than this at the money straddle value, imagine the stock is up 30 bucks, 40 bucks, 50 bucks, or imagine it's down 30, 40, 50. You paid $16 for something that's worth now 30, 40, $50 in value. Because even if the stock goes down and the calls expire worthless, if the stock goes down 40 points, the puts will be worth 40 bucks. So you paid $16.50 for something you can sell for 40. You paid $1,650 for something that can be sold for $4,000. That's a big windfall. That's a big profit. The problem is again, you're only going to be successful a lower probability of the time, but you have a big potential payoff. That's the option buyer. The option seller basically would take the other side of that, and he'd say, well, what if I shorted the strangle, which, by the way, is very dangerous. It's a naked straddle here, and the straddle just refers to the same strike on the 86 call, 86 put. That's a straddle. So if you did a short straddle, you'd collect 1650. What are you betting on? Well, you'd be betting on a volatility crush, that the stock will basically flatline to a certain extent. Yeah, it's going to move, but it's already priced in. So if the stock only moves $8 and it's priced to move 16, if the stock moves $4 and it's priced to move 16, you're going to have a nice profit tomorrow already in the trade. The volatility will get crushed. These options will collapse. You collected 1650 as the short straddle trader. You might be able to buy it back tomorrow for $8. You made $800 overnight playing the volatility crush. You'll get that trade right most of the time, but you're on the other side of this risk. If it blasts to 40 in value, now you got a huge problem. You collected 1650 and now you have to buy it back at 40. You got a big messy situation. So this is how you can think through the options market. You could take either side of any trade. Now, we don't have to do those strategies per se. We could build any strategy we want. But if you're doing anything similar to the short straddle, what would be similar to the short straddle? Well, a short straddle, a short strangle, an iron condor, an at the money butterfly. So I'll say iron condor, butterfly, that's around at the money. These are all playing for a volatility crush. You're a short option trader. If the volatility collapses and the stock doesn't move much, these are successful. What does the long trader do? Well, you could go long the straddle. You could go long a strangle, which would cost less. You could go long a spread. You could go long a single option, just buy a call or buy a put if you were directional. These are all examples of playing for more volatility, playing for less volatility. But you, as an earnings trader, you have to decide which side you're on. Okay, any trade you take is going to have some aspect of either being long volatility or short volatility. That's the fact. That's kind of the reality of this. If you did some at the money calendar or diagonal, you're on this side. Okay, if you're pricing this to be right around these levels and you do some sort of diagonal spread or calendar spread right around current strike prices, you need a volatility crush. If you get it, you're going to see a profit. If you don't, you're going to have a loss, right? If you buy some ratio back spread where you buy a bunch of puts and sell one against it, something like that, well, that would be a long volatility trade. So there's There's a variety of different strategies that can take one side or the other, but you are literally, whichever strategy you choose, you're on one side of that or another, right? Now, some traders say, I just avoid earnings. That's fine. Some traders say, well, I trade earnings, but I'm really patient and wait for the right pitch to swing at. And that means watching a lot of these earnings go by and not caring what it does. And that's me. I think that's the right approach is you basically don't put any earnings trade unless you have a combination of factors that really lend itself to some, you know, good pitch to swing at, in other words. So do I trade some of these through earnings? Yeah. Do I trade some of these through earnings? Yeah. But I'm very, very picky. On any earnings season, I'll trade a couple of few earnings results, but I'm very mindful of what strategies are working, what the earnings kind of forecasts are, what my expectation, why I think I have some insight into what they're going to do and how the market's positioned. So if I say, the market is just underestimating how good it's going to be for energy, well, I'm bullish, right? If I say, boy, energy's already priced in this massive upside and now it's going to kind of level off, and I think oil prices are going to come back down a little bit, well, then I'm going to take the other side and be a little bit more bearish, thinking that now the market's pricing in a lot of that. And interestingly enough, that's kind of where I find myself is I took profits last week on a lot of my energy longs. Now, energy's gone a little bit higher today. Specifically, it did go down and now it's back up. So was it perfectly timed at the top? No, it's actually a little bit higher today than where I sold a lot of those energy plays. Actually, Oxy's a little lower, but anyway, for the most part, I kind of think a lot of that good is now priced into earnings, and we're starting to see some deflation. So many people get caught up in the most recent thing, and you have to be careful because you don't want to be the last one in, right? The bag holder. And that's where I worry about inflation. Inflation is, I think the markets are at risk of overvaluing how much inflation there's going to be. In fact, Target's numbers that they came out today with is huge deflationary. Think about it. Less demand, lower prices. Those are deflationary. That's not inflationary. That's deflationary. We're starting to see some job losses, and there was news Tesla's laying off and so on. That's deflationary. So the market is kind of like a pendulum, and it overdoes it swinging in both directions. And I want to fade the huge nervousness on inflation right now. I actually would go the other route and kind of play that there's going to be a little bit bigger drop in inflation than the markets realize. So you have to feel like you have some edge and some opportunity. Now, you can track earnings. If you want to build a little bit of a track record, here's what you can do. Pull up an Excel file and just keep track of some things. So what I could do, let me just show you, this is kind of fun. If I said DocuSign, you could even go back and back test. But if I wanted to track DocuSign for a little bit, I could just track its at the money straddle value today and then see what it's going for tomorrow. And then say who won. Who won. So I would, pull the number today right now, and we said it's like 810 plus 840, so it was 1650. So I would say right here, go to my Excel file, and I would say 1650 for the at the money straddle. Okay, and I need the details on that, so I need to put in that it's the 86 strike, so I don't, forget and so forth. And I need to know that that's for June 17th expiration is what I was looking at. Okay, so I need to keep track of some of the details. But then I could say tomorrow, or actually they report Thursday. So I guess if you wanted to do this better, you'd pull the number tomorrow, Wednesday, right? Or even Thursday if they report after the bell. But basically you pull this number the day before earnings, then you take the value the day after. So let's say that hypothetically DocuSign was reporting tonight after the close. Well, it would make perfect sense. We pull this straddle value today, and then about this same time tomorrow, we'd just come in and say, well, what's the 86 strike June 17th straddle going for? And if we put in any number lower, let's say it's going for 1230, who won? Okay, the short. Anyone that shorted vol won. If, however, you put in that it's going for 1980, well, then the long vol trader won. And you could actually track this for a little bit and kind of get a little bit of a track record for certain stocks that you might like to trade through earnings, and just kind of see if there's any trends on this. I traded Apple this same way for many years because Apple was really interesting. It works best, this type of concept. You need a lot of emotion in the market. And emotion comes from the public, really. The public gets all hopped up, and overly positive, overly negative. The general public just is an emotional roller coaster. Okay, that's the reality. And not to offend anyone, but the general public is just overly emotional. So they feel, they complain about oil right now, or they just feel horrible about it. They feel, too optimistic last year. And they're just a constant roller coaster. If you know that the public is heavily involved in something, and for many years that was Apple stock. And what they would do is they would just come in and they would buy options, specifically buy calls, because they knew, oh, Apple's a great company, and usually stock price is gonna go up or whatever. The public would just buy calls. Guess what would happen? Well, they price them in. If people flood in to buy calls, then the call sellers keep raising their prices, and pretty soon the premium that these guys pay to buy those calls is much more than what Apple tends to move. And so Apple was just a fantastic short volatility trade for many years because the general public would just come in and buy options. The options would get overpriced and inflated, and it would just be a moneymaker. You could short the vol in some capacity, put on an iron condor, put on a butterfly, put on a short straddle, short straight, whatever. And it was like printing money. So if the public gets heavily involved in something, in this case, they pumped up the Apple options, way overdid it. And it's not just the public. I mean, there's a lot of RIAs and a lot of people out there that manage money that frankly are no better than the general public. They're not super savvy. They don't have a lot of experience. They're kind of just trying to figure out on the fly how to make money, and they're just testing things out, and so for them it was, it's always a surprise to people when they buy calls and then the stock goes up a little bit on earnings and their calls go down. And they go, what the heck? I bought calls, the stock price went up and I'm losing money. Why? Well, because you overpaid for them. The vol got crushed, so even though the stock went up, the call's worth less than what it was, And so the short vol trader was just winning over and over again. So if you wanted to build a little track record, pick a stock, follow it for a few earnings reports, and just say, what is the straddle value the day before? What is the straddle value the day after? And you can see who's winning. If you had done this trade, you're winning if the straddle's worth less than what it was the day before. If you did a long vol trade, you're winning, if that at the money straddle is worth a lot more. That's the general rule. And what you'll start to see is the short vol trader wins more times than not, but has some spectacular blowups. And so, that's the negativity of being a short option trader, is you have to, I'm a believer that anyone that does short vol trades has to know how to delta hedge and do a variety of different things, because to say you have high probability is one thing, but if you think you're just going to roll your trade forever and make profit, it just doesn't work that way. You have to, on the ones where the stock is moving more spectacularly, you're going to have to know how to manage that risk and do some things to really reduce that worst case scenario. And if you can do that effectively, you can be a short vol trader. If you sit and hope that it'll come back and that it'll get better and so on, you're going to experience quite a few blowups. So kind of fun. Let's do 2 examples before we wrap up. Let's say that you wanted to trade DocuSign and you wanted to be a long vol trader. You expected a big move. Well, you could do it directional, right? You could do it bi-directional. You could say, well, I don't care where it goes as long as it moves violently. So the easy approach would be to buy the straddle. Just buy the 86 strike call, which would have unlimited upside if the stock goes up, and simultaneously to buy the 86 strike put. Now one is going to make and one is going to lose, depending on which way it goes. This is a long vol trade because you need whichever way it goes to make more than what you paid for the sum of both. So even though your puts lose if it goes this way, the calls can overcome that. They can make so much that they go well past what you paid for both options. So if you were doing a long straddle, it's pretty expensive if we think about it. Think about this on a percentage basis. Paying $16.50 for a straddle divided by the stock's price at 86, we'll call it. How much volatility are they pricing in these shares? 1650 divided by 86 is 19%. You're paying 19% of the total stock's value. So you need a big move. Okay, this seems pretty expensive, but the market's pretty darn nervous about the blowups that DocuSign has had, and it's conditioned the markets to be nervous, right? So the buyer of this would say, well, if I think it's going to have another blow up, I'm going to click here. I'll go buy a straddle. Let's take it down to 1. We'll just buy that June again, 16. We called it 1650. Maybe you could get in at 1630 or whatever, but it's somewhere in this ballpark, right? And that's what you would do. You'd buy that option. And if we look at how that trade would look, let's see what we've got here. Do we have some other stuff in play? Let's delete. I don't know what that is. Let's delete. Here's what your risk graph would look like. Spread this out a little bit so you can kind of see it. And maybe I'll bring it back in just a touch right there. Okay. What does the long straddle do? Well, it shows you that, man, do you need a big move? If this stock is anywhere between here, about 70 per share, and way up here, 100 and something per share, you got a problem. In fact, we could set our price slices to break even at expiration. And if you stay in this trade until expiration, you're not profitable unless the stock is either above 102.33 or below 69.72. That's a big ask. That is a lot to ask. That is a huge move. Like we said, these options are highly, highly priced. I picked this stock for a reason because the market has been conditioned to say DocuSign has blown up in our face once. DocuSign has blown up in our face twice. We're not going to let it blow up in our face a third time. And that's what they're nervous about. I think, actually, that it makes more sense to kind of take the other side of that. So instead of doing a long vol, we could do some sort of short vol trade. Now, how risky and how aggressive and how all these things you want to go, that's up to you. Let's create a butterfly. Let's do an at the money. I don't trade a lot of sideways butterflies. You've seen my classes probably on targeted butterflies. I do a lot more of those than the sideways ones. But let me just show you. Let's kind of build a a big old butterfly. Let's give it at least 10 points out. There's not those strikes, so we need to go on the 5s. There we go. So look at this butterfly. This butterfly is going to cost you about $1.95. The most you can lose is $195. How are you successful? Well, now you've got to find the middle zone. You're going to have some sort of volatility crush in this. Because if it has a big move this way, you'll lose. And if it has a big move this way, you'll lose. And you'll end up at max losses. But if it finds this happy zone, you're going to make some money. And you could make up to 4 times your risk. You know, you can make upwards of $800 on less than $200 of risk. But you're probably not going to land it perfect. But you could land it anywhere in here to a big profit, right? So there's a big profit window. And that would be a short vol trade. That would say if this stock has a little bit of a dud through earnings and spends a couple of weeks kind of in this range, this trade will keep going up and up and up in value. In fact, if we were to scoot this forward, what you'd see is as you get closer and closer to expiration, more profit builds inside of this zone. See it? And then when you get to expiration, you're left with this risk graph. Wherever you landed, that's how much you make. So if you land at that price, you're up $550. If you land at this price, you're up $607 in profit. If you land right here, you're up $289. If you land right here, you're at $97 of profit. If you land right here, you're at break even. If you land right here, you lost 90. If you land right here or anything lower, you lost 195. So if it moves sharply, lower or higher, well, the long vol trader won, the short vol trader, which is what this would be, lost. So kind of fun to look at different examples of how to take advantage of what your expectations are. Personally, I would expect, now we know the 3 things. We know DocuSign's going to move more than it does on most days, but is the options market already pricing that in? Yes. And I would argue, and then some. It's not only pricing in moves, it's pricing in the fact that the last 2 reports were big blowups and the market's nervous going in. And that creates opportunity. When the market gets super nervous, the public gets super nervous, that's where options have an opportunity. So if the public is aggressively buying puts, thinking that it's going to implode again and so on, I like to take the other side of that trade. And that's where I think you are in this particular trade, this example. So good stuff. Hope you enjoyed this. Hope you learned some things about trading earnings. Nice working with you as always. Have fun. Let's see. Joe had a question. Whoops, I almost missed it. How long is volatility priced in prior to an earnings report? That's a great question. Usually, implied volatility does this. It increases. Look at this chart. Here's earnings. It increases going into the announcement. It gets crushed after. Earnings coming out. It's been increasing going in. Probable that it gets a volatility crush going out. That's pretty much the norm. The biggest jumps in volatility tend to happen the couple of weeks before earnings come out. So actually, a long straddle, long strangle trader might do better buying it a couple of weeks in advance and then selling it before earnings hit. You know, kind of playing for that volatility to spike going into the earnings, but then get out before the earnings actually hit. Because you know, once the earnings come out, there might be a vol crush, right? But you could play for that increase. The fact that people get nervous as the earnings date approaches, so the options get more and more and more expensive, and then the earnings come out and the options kind of implode. There's a bit of a volatility crush aspect to them. Good stuff and great question. Thanks again, everyone. Have a great rest of your day. We'll see you next time. Goodbye, everyone.